Welcome to this webinar on bridging the gap between finance, tax, and IT. In today's session, we will explore the topic of operational transfer pricing. My name is Svein Baumann Larsen, and I am joined by my colleagues Kate Bennest and John Scott. In today's session, we would look at what operational transfer pricing is and why it is important. What makes operational transfer pricing a challenge? Who is responsible for operational transfer pricing in a multinational? What are the typical key features and characteristics of an operational transfer pricing solution? The approach and the technology to create an operational transfer pricing solution? The benefits typically derived from an operational transfer pricing solutions? Key messages and takeaways before we end the session by opening up for questions. So what is OTP and why is it important? If we start with the first question, what is OTP? Over the last years, we've seen a lot of different definitions of what operational transfer pricing is all about. Some have claimed that operational transfer pricing is merely a process standardization exercise, while others have referred to it as a governance exercise, and yet again others to a technology exercise. In EY, we believe it's a combination of them all. And operational transfer pricing for us is all about the effective application of your transfer pricing policy on financial accounts and in financial systems. You might ask why that is important. I think over the years we've identified three key value drivers. One, which is tax risk and compliance. One, which is cash leakage. And one, which is efficiency. If we start with the first one, tax risk and compliance. We see that the tax authorities are constantly asking more granular questions. They're expecting multinationals to report a level of granularity in data which they previously did not. We see that HMRC is requesting multifunctional legal entities to produce segmented P&Ls. We also see that tax authorities are asking for value chain profitability on a certain product. And the only way such reporting will be possible is by the appropriate technology enablement. On the efficiency side, we also see that multinationals are spending an unreasonable amount of time manually processing figures that comes from accounting systems for which they do not derive the data themselves. Often data is gathered from multiple sources and in different accounting standards, all which needs to be adjusted, manually processed, before any transfer pricing calculations or adjustments are posted. The last important aspect of operational transfer pricing is cash leakage. And what we've seen here is that there is a discrepancy between the transfer price and the customs valuation. And in this case, we tend to see that multinationals relying on a spreadsheet-based approach for calculating their transfer pricing and conducting their retrospective transfer pricing adjustments, that discrepancy leads to either an overpayment or an underpayment in customs duties, risking your compliance position. If we look at numbers, we often see figures above 6 million euros in cash leakage just arising from retrospective transfer pricing adjustments. In the next slide, we will look at why operational transfer pricing is a challenge. And Kate, perhaps I may ask you to continue with that.
So thank you, Simon. And yes, we've heard from Simon on why multinationals care about operational transfer pricing. So let's now take a look at why operational transfer pricing is such a challenge. I think, first of all, it's important to say that operational transfer pricing is not a vertical exercise. It's not one that's siloed that can be performed in tax and solely by tax. But it's rather a horizontally integrated exercise that requires several business functions and people to work together to partner together. And we saw at the Tax Transformation Summit that business partnering across the business became critical to actually achieving the results and getting collaboration to work together. In the recent company we've worked with, 4 business functions in total were involved. And that was transfer pricing in the tax area, costing, segment controlling, and global business services. These functions operated across the business, including local finance, regional global business services, and segment controlling and group tax. Controlling such a complex process requires standardization and structure to avoid the inefficiencies. But more so, it also requires data and technology enablement. And as much as Simon was talking previously, the technology part of it becomes crucial in this area. Now, on the screen, you will see the results from our operational transfer pricing survey. Now, this survey has actually been answered by more than 220 multinationals to date. In the graphic to the right, you will see the intercompany dimensions. These have been mapped alongside the transfer pricing life cycle. That we'll show more of when we just come on to talking a little bit further about who is actually responsible for the OTP. But the mapped against alongside the transfer pricing life cycle, and we undertake a detailed assessment per process step to ascertain a level of maturity against leading practice. In this example, we are showing the current state of tax, finance, and the leadership team. Time and again, we see quite clearly that lack of technology enablement is one of the biggest weaknesses, and that most multinationals are looking to improve this, as you can see from the graphic itself. The current processes require significant, complex manual adjustments to data. So if we now look at who is responsible for operational transfer pricing, we've seen that the current transfer pricing processes are complex and involve a number of business functions and people. And I'm not sure the question, who is responsible for operational transfer pricing, can be easily answered, although the ultimate accountability sits with the person accountable for local statutory accounts. From there, we see responsibilities being assigned to business functions and people engaged across the transfer pricing life cycle. As you can see from the graphic there, from planning and policies right through to controversy and litigation. So, I'll try and use an example. As a team, we're working with this client at the moment, which is multi-billion-dollar revenues, where they want to adjust their transfer pricings going forward. That is to say, prospectively. And that is done by segment controlling. However, segment controlling cannot see the net profit, EBIT, which is required for a return on sales calculation. Only the gross earnings for managerial purposes. As a result, group tax and transfer pricing have to do another complex calculation, whereby they try and forecast what the assigned indirect cost per legal entity should be. For the segment controllers, this will be below the line. Then, in the example I'm just talking about here, there are 2 instances of global services involved. Global local services try to allocate overheads and indirect costs to the appropriate segment and product lines in the legal entity, and global regional services try to allocate the below-the-line items, including IT services, general corporate services, to get the final EBIT. Then global services calculate the return on sale per product line and cascade any price adjustments down to all the materials within a particular product line to get to individual material prices. These individual prices are then sent to 3 different, in this instance, it's SAP, price procedure managers to upload them into the transactional system, which you'll hear more about as we move on through this webinar. From that example, you can see that there are a number of functions and people involved with separate responsibilities. However, the process is so complicated that there is no one person that can oversee it or control it. And so that is the reason that there's need for simplification, and to do this, that requires connectivity across the organisation, requiring a connected tax and transfer pricing function. So connecting it to the enterprise and IT, connected to finance, accounting and controlling, and ensuring it's connected to global business services regionally and locally. In short, the business functions need to partner with each other to harness the power of collaboration to deliver transparency and trust in the results and bridge the gap between finance, tax and IT.
Thanks, Kate. So now let's spend a few minutes talking through the key features and characteristics of an operational transfer pricing solution. I think the first thing to say is that an operational transfer pricing solution is not just a reporting tool. We need a calculation engine to perform the necessary allocations and calculations to, first of all, calculate the transfer prices, then calculate a segmented P&L so we can monitor the margins, and calculate the adjustments that we may need to make through a variety of different methods. Historically, we see companies have tried to achieve this through the use of Excel spreadsheets, and this often means a lot of time spent manually collecting data, managing master data, running calculations, updating the model to reflect changes in the business, and issuing the reports. We see there's a huge opportunity to automate these activities through improved use in technology. I'd just like to take you through step by step some of the key features that we see in our operational transfer pricing solutions. So the first step is to automate the extraction and collection of data. Now, we've heard previously that we see good practice as managing our transfer prices prospectively. To achieve this, we need a combination of actual data, budget data, forecast data. And usually we see multinational organizations having this data in disparate sources. So our operational transfer pricing solution needs to be able to connect to multiple different data sources and automatically manage the extraction of that data into the calculation engine. That's step one. The next step is then to enrich that data with what we call transfer pricing master data. So for example, we need the TP functions that an entity performs. We need to add the interquartile benchmarks and ranges that we'd like to target. Many of these activities can be automated. So for example, we can automate the supply chain identification and the TP assessment through looking at the combinations of master data to derive this, and this removes a lot of manual activity. Once we have all of the transactional data and master data required, we then need to perform allocations and calculations. So for example, we may need to allocate our indirect costs onto the necessary segments. And we can manage this at various levels in the product hierarchy. Some organizations wish and need to go down to SKU level. Other organizations may need to monitor it at a high level in the product hierarchy. In terms of the calculations, one element is looking at the TP adjustments that need to be made. However, these should be made in consideration with other functions such as VAT, customs, stock valuation, and hedging. So I'll come back to that in a moment, but within the calculation engine, we should be able to run different scenarios and what-if analysis to understand the impact of a TP adjustment on these different areas. Finally, we also need the ability to make manual adjustments to the data. So of course, for TP calculations, we need local GAAP figures, not consolidated IFRS. And that often means that we need to adjust the source data that we're taking. We may also need to make some reclassifications or adjustments for particular accruals or provisions. And this leads us up to a data set for our transfer pricing segmented P&L. So if those are all the inputs that we need, let's now take a look at the outputs. So what we're looking for is a segmented TP P&L. So relating this back to the transfer pricing processes earlier, we're now at the monitoring point of view. So we can have a look by entity, by TP function, the margins that are being achieved, and to monitor if they're in line with the TP policy. And to the extent that they're not, we may need to make an adjustment, and we've got different mechanisms by which we can apply that adjustment. So in terms of the outputs, we can have a look at the segmented P&L. We've got a concept of managing by exception, so that we can, the reports and the tools flag to us where we have deviations, and we can focus our attention on the most important items rather than reviewing many, many lines of data. We mentioned before about the impact TP adjustments can have on other areas of the business. So we've got a concept of intelligent TP adjustments, where we can quantify the impact that we may have on customs, VAT, inventory and stock revaluations, or indeed the exchange rates and the hedging. The transfer pricing tools, in addition to the calculations and the reporting, also provide an audit trail, so we can go back in time and explain how the policy has been applied to the financial statements, if we need to do that for a tax audit or an inquiry. Other key features of these tools is to provide the workflow necessary for the connected TP function that Kate was talking about, so that we can manage, through the use of technology, the interaction between tax, finance, the costing teams, the legal department in an efficient manner. Finally, the output of the segmented P&L can feed into other processes, for example, country-by-country reporting, and we can integrate this from a technology point of view to deliver additional efficiencies. So that's a little bit about the technologies, key features and functions. I think it's also important to make people aware that often multinational organizations have the applications and technologies already within their IT landscape, meaning they don't necessarily need to buy additional tools to create an operational transfer pricing solution. In the next slides, we'll start to look at what these solutions can actually look like.
So let's look at the approach to operational transfer pricing and the technology enabling it. When we look at operational transfer pricing software, it's intended to do three things, basically. That is, help multinationals set the transfer prices, help multinationals monitor the transfer prices, and help multinationals adjust the transfer prices. As John alluded to in the previous slides, we've also seen development of transfer pricing solutions over the last decade, whereby 5 years ago, operational transfer pricing tools were predominantly looking at what were the transfer price by means monitoring. In today's world, with today's technology capabilities, we've seen that the operational transfer pricing solutions enables the three processes just mentioned a lot further. So if we start with the monitoring aspect, we tend to see that the transfer prices are monitored in accordance with the transfer pricing policy. But we also look at the adjustment mechanics, and not only how to adjust the transfer price by using a credit note or debit note, or doing it prospectively by changing the cost of goods sold. We're also seeing that the newer generation solutions take into account the knock-on effect that transfer pricing adjustment may have on customs, duties, VAT withholding taxes, but also how it impacts the treasury function and any hedging programs that there might be. If we look at the technology on screen, which is a simple illustration of an operational transfer pricing dashboard using SAP Analytics Cloud, what we can see here is that we are taking data and producing information from those data. Typically, this involves leveraging a lot of different techniques, but the dashboard that you can see is developed using a principle called management by exception. What that does is it allows you as a transfer pricing manager to have your attention drawn to any operating location within the geographical map that may have a deviation to your policy, or that may be in breach or violence of your transfer pricing policy. As such, you can drill down to these deviations and see how much you deviate, for example, from your operating margin. And as you do these drill downs, you will also see other key figures start to change. For example, you will see the country-wise sales change. You will see the product and the product flows change. John, do you want to add to this one?
I think it's important for people to understand that that these are customizable and that you can add the metrics that are important to your organization, and that really these are end user tools. So with very little training in tax, finance professionals can use these without an over-reliance on IT.
I think that those are very important perspectives, John, and I think adding to that, what we see is end user tools as well. These are used for visualization, but it's not really here where the transfer prices are calculated, John.
Indeed. So these dashboards are really showing the results from the calculation engine. And it's the calculation engine where, in the previous slide, we spoke all the calculations, the allocations, making sure that we're respecting thresholds or specific transfer pricing rules. All of that information is within the calculation engine layer, and this is really the visualization of it, which can go out to a wider audience.
Mm-hmm. And when we look at these calculation engine layers, John, this is typically also what multinationals are using to calculate managerial profitability. So I would expect that most multinationals have tools already in place for which they can develop these type of solutions. What do you think, John?
Yeah, absolutely. We often look to what finance are using for their core forecasting, planning and analysis capability and processes. And indeed, there's a large degree of overlap in the data that we're interested in. So we're interested in the actuals data, the forecast, the budgets. So there's perhaps just an augmentation required for the transfer pricing purposes. So organizations don't necessarily have to go and buy additional technology or additional applications for the purposes of operational transfer pricing. More, we can look to what finance are using and utilize those same applications.
Indeed, John. That might take a variety of different applications. It might be built out of SAP or Anaplan, or it might be configured in Oracle. Most likely, you as a multinational will have the tools and the means to configure an operational transfer pricing solution internally, and thereby creating a segmented P&L, as we will see on the next slide.
In this screen, we can view a segmented P&L. So again, across the top of the screen, we've got filters, so we can look at company code, and we can look at the TP functions within a specific company code. In this example, 2 different manufacturing entities, but equally you could look at different functions across the supply chain. And we can look at our P&L from gross revenue, the individual rebates, discounts, down to net sales, our COGS, all the way down to operating margin. And we're able then, this supports the process of monitoring, so we can look at the actual operating margin achieved and compare that against our benchmarks and our targets to ensure that we're in line with TP policy. As we've mentioned a couple of times, we're also enabled to take that prospective view by enriching the actual data with forecast data, so we can look at what we think that outcome will be at the end of the year. On the top right-hand side of the screen, we've got some additional metrics. Again, you can customize these to whatever is interesting to you and your organization. In this example, we're looking at net sales, gross margin, and operating profit. And we're looking at the GeoMap to see the distribution of that profit, in this example, by country. But again, you could look at it through the different areas of the supply chain. On the bottom right-hand side, we're looking at gross margin over time. This is an interesting metric, perhaps, in context of customs. So if we think that a variance of perhaps over 10% year on year may trigger the interest of customs authorities, this is where we can start to build up the audit trail and the historic data to help us with the compliance areas. And Simon, perhaps I'll invite you just to comment on the additional analysis that we can take.
Thanks, John. Yes, no, I think on the segmented P&L, it's not only interesting to look at what is the real profitability by any level in the product hierarchy. I think we also need to realize that there is a need to avoid anti-dumping. By means, we need parameters that compares the sales price with the group standard cost. That's a very typical parameter used. But we also have parameters that we're actually measuring the operating profit against, such as the interquartile range, which is important, and basically a replication and representation of your transfer pricing policy. But we also tend to see other parameters being used, such as APAs, customs, price change in nominal figures, and also price change in percentage. All parameters which are intended to give the transfer pricing function better information to steer and decide as to how they want to change their transfer price, either retrospectively by using a credit note, debit note, though being linked to your product or service hierarchy, or doing a prospective price change by means changing the actual transfer prices, the cost of goods sold, for example, between a principal company and a distribution company, which again would lead to a new transfer price procedure that will have to be posted or uploaded in your transactional system. John?
Yeah, thanks. And I think that last point of that link between the operational transfer pricing solution but reflecting those changes back into the transactional system is really important. We often see that as a pain point with organizations spending many, many hours manually applying those changes or validating that they're correct. What we're able to do is to create a semi-automated process where we've got system-to-system connectivity. The reason I say it's semi-automated is because we still think there's a need for controls and human review before those changes are applied back to the transaction system. But that's one of the areas where we can see a lot of efficiency. And of course, it's not just the technology that delivers a operational transfer pricing solution. We need to consider it in context of the governance, the end-to-end processes, and the controls. And it's all of those things together that typically deliver the business case and the benefits, which I'll come on to talk about in a moment.
Thank you very much, John. Before we talk about the business case and the benefits, I think it warrants a bit of additional insights as to what these type of solutions supports on when it comes to workflow and content management. As Kate alluded to previously, the transfer pricing life cycle is composed of multiple processes which are spread across multiple functions. And having a sound workflow and also content management is really critical. And this is surely something that we tend to see newer applications have installed and in place. That, again, would ease the interaction between, for example, a shared service center managing the calculations and whomever sits in a headquarter that would review those calculations before proceeding to the next activity in an activity chain. John?
Indeed, I think that really fits with the efficiency value driver that we have. We have many interactions between different teams, and the workflow can really automate that and then just make it much more efficient and smooth. So let's now look at the benefits of a structured operational transfer pricing approach. And we've spoken about the three different value drivers: mitigating tax and compliance risk, reducing cash leakage, and improving efficiency. So let's just walk through those one by one and illustrate some examples as we go. So if we think about mitigating tax and compliance risk, one of the benefits of the technology solution is that we can build that historic data set, meaning if an audit occurs, we're able to access the data, the models in an efficient manner and therefore reduce the time spent of retrieving that data, performing the analysis, and understanding it. So what that really means is that we can reduce the penalties paid from audits because we're able to better defend them with facts and evidence, that we can reduce the number of TP adjustments and the deviations not adjusted for. So that's achieved by taking more of a prospective process throughout the year, that we can reduce the TP provisions held on the balance sheet because we're more confident in the numbers that we're producing, again, making regular adjustments throughout the year. We've reduced the impact on customs. We've spoken about the cash leakage, but equally, if the price is under the correct amount, then we've got a compliance risk because we're not paying enough duty. The same is true of VAT. So those are some examples of where, through the better use of technology and integrated process, we're able to reduce the tax risk and compliance effect on the organisation. And that can have a real kind of cash saving as well. If we then look at the efficiency piece, we've removed the manual activities of collecting data, processing data, performing the calculations, managing cumbersome Excel spreadsheets for changes to the organisation or changes to the TP policy through an automated model. That's one step. We've also spoken about the efficiencies through automated workflow. So we're managing the interactions between tax, between finance, between legal, and that we're building up the approval and controls in place within the organisation, which links back to the compliance point of view, where we're able to evidence the governance that's taking place over applying the TP policy correctly. That efficiency saving can be very significant. We spoke in a previous slide about the technology integration from the calculation engine back to the transactional systems. One organisation I worked with recently posted manually 4,000 year-end adjustments, and we're able to automate that for them, which gave a significant saving. The final area is where we typically see the largest benefits in terms of creating a business case, and this is on the cash leakage. So we've given the example a couple of times of customs, where perhaps the price is wrong throughout the year, it's too high, we don't have the facts and the data available to evidence why, and to reclaim that from customs authorities, representing direct cash leakage. We also commonly see examples within hedging, perhaps where the transfer pricing function has not forecast the adjustments required at year-end, where those adjustments are significant in monetary value and they need to be made in various different currencies. We've not informed hedging, and therefore they're exposed and they're not hedged appropriately. To quantify that, one organisation we worked with recently had a 1.5 million euro exposure at year-end just on the hedging. And that was happening year on year. It's not just a one-off. So those are just some tangible examples of where we see cash savings manifest. I think it's fair to say that when we create a business case with organisations, we're seeing a return within the first year. I think that's quite compelling to understand. So, Simon, I don't know if you've got any closing comments that you'd like to make on the overall benefits of these solutions.
No, I think you said it very nicely, John, at the end there. We do see, in fact, a business case which is positive within the first year.
Thank you.
In wrapping up this webinar, there is a couple of key messages and takeaways that we would like to provide you with. First of all, how do you get initiated an operational transfer pricing project? In our experience, it is easiest to do so if you have a change agent active in your organization. And a change agent might be an IT transformation, a finance transformation, a business restructuring, and a supply chain. In that regard, we also have experienced the importance of recognizing the buying communities for operational transfer pricing projects. And generally, we see three buying groups. The first buying group is the functional buying group, which will define the functional capabilities of the operational transfer pricing solution. This would typically be tax. The second buying community we call the influential buyer, and that is typically IT, that will influence the technology selected in comparison to the overall roadmap of technology for your organization, license management, and the like. The third buying community or buying group would be the financial buyer, which is again going to release any budget or funds for you to initiate your transfer pricing project. So if we then look at the key takeaways, make sure that you obtain support and buy-in from your colleagues and top management. Make sure that you're capable of communicating your requirements and processes. Also be aware of the complexities in communication. There's different regions, different business functions, and they tend to speak different languages. Lastly, we just want to point out that often the devil sits in the detail, and good reports really require a thorough and in-depth understanding of the data. By that, we will close the webinar and open up for questions. So hi everyone, and welcome to the live round of questions. Thank you very much everyone for listening to the webinar, and I'll now try to answer any questions that you have. To the extent that I will not be able to answer the questions, I will get back to you if you can share in the questions posting your name, and I will get around with that and reach out separately. So I see that there is one question based on my survey. Where does OTP organizations report into? I think what we see there is there are multiple reporting lines. Very often we see that from a systems perspective, the ones being responsible for managing the operational transfer pricing by means looking at what is the profitability, do we need to do adjustments, they tend to sit in a shared services or global business organization, and they would often report into group tax and group transfer pricing. In addition to that, once the reports have been made, I think we also see a discussion between the proposed adjustments and actually how the adjustments should be conducted in practice. And in that regard, we see that stat account responsibles are all approve any of the active adjustment, or being it a cost of goods change, which again will change the pricing procedures or conditions in the underlying transactional systems. The second question is, how do you deal with privacy in terms of having direct insight into the ERPs of the clients? In this regard, we as EY do not have direct insight into the ERPs of the client. We are not running these calculations, but we enable the multinationals to run these calculations and activities themselves. I do know that certain organizations are creating hosted transfer pricing solutions, which are reliant on a data transfer between the client's ERP system and the service provider's cloud environment. And in that regard, typically I see a lot of questions arose around GDPR just in general and data governance and data management. But
for those service providers, I wouldn't know exactly all the ways that they are setting this up. The third question that has come up is the TP master data is only a part of the overall master data management in a company. Would you expect a certain level of integration between traditional OTP functions and more supply chain oriented master data? And then I see it says vendor, plant, etc. Yes, the answer to that is yes, indeed. We look at the master data that already is in place typically, and that those master data processes may or may not be more or less harmonized. Typically, the master data processes that sit for the ERP system is processes that we are not influencing too much. We tend to see that master data enrichment for transfer pricing purposes is normally happening at a data repository level. So might, for example, be in an SAP BW where you actually enrich the data with the necessary TP master data, such as TP function, TP method, brand, and the like. Are there any more questions? Please feel free to drop them in. If there are no more questions that comes in, then I'd like to thank everyone for listening in, and also let you know, feel free to reach out to me if you have specific questions that you want to get a broader discussion around for your organization. So then I'd suggest we will end the session as no more questions are coming in.